Good afternoon. Thank you for joining us for our SEL Interdisciplinary Research Seminar today. The lecture is the third installment of our four-part seminar series co-hosted with O9 Solutions. Today we have with us Asim Kohli. He's Vice President of Product Management and Marketing with O9 Solution. He's joining us from Atlanta, Georgia. Our moderator for today's session is Alan Herrera. He's the Associate Chair for Research and the UPS Professor of Logistics, the Stewart School of Industrial and Systems Engineering. Dr. Herrera is also the co-executive director of the Georgia Tech Panama Logistics Innovation and Research Center. He's also faculty director of our MS in Supply Chain Engineering program.
Right, thank you, Andy, and thank you to all the participants, all the attendees who are coming to our seminar today. I'm very pleased that we have Asim Kohli today from O9 Solutions speaking on inventory optimization, a very interesting topic area. And I know that part of the presentation today will include a demo. Asim is going to help us understand better these systems, and he's going to bring to bear his over 20 years of professional experience in the areas of inventory optimization, network design, S&OP, et cetera. So without further ado, just to get things rolling here, I'm going to turn it over to Asim. Again, thank you, Asim, for sharing your presentation with us today and your time. And I look forward to a lively presentation and discussion afterwards.
Hey, thanks, Alan, and welcome, everyone. Thanks for giving me this opportunity to talk about inventory optimization. So, I think as Alan mentioned, roughly what we're going to try to do is we're going to talk a little bit about O9, like 2 or 3 slides. Some of you might have attended some previous sessions by my colleagues, so some of you might already know about it, but O9 might be new to some others. So just 2 or 3 slides there, and then we go into the topic, into the agenda, the main agenda for today. So I'll talk a little bit about inventory optimization, talk about some concepts, some terms, some benefits that we have seen with our customers, and then go into capabilities and use cases. So I'll switch between the slide and the demo itself. And the intention would be, at least from my perspective, there are things that you guys have read in theory, and a lot of that from our commercial side, we pick up and we try to put it in practice. So my intention today would be to tie the two and then show you how it works in the software, and then give a perspective of how our customers have been using it in some use cases. Again, this is a very interesting topic. There's a lot of things that you can go in far more detail, both on the math side and then on the practice side. But the intention would be to just to give you a more flavor of it. And then for sure, as you have more questions or if you want some more detailed info, we'll be happy to take it after this presentation today. Okay. So with that, just a single slide on O9. We were founded in 2009, so we are a relatively new company and growing very rapidly. So I joined O9 about 2 years ago. Before that, I was with I2 and JDA, so I have over 20 years of experience. So when I joined, we were roughly around 200 ballpark. And within the past 2 years, like we have grown to 800 plus, I think must be 900 plus now. So we are growing rapidly, and we are a unicorn company. So KKR invested in us about a year ago, and valued O9 at over $1 billion or so. Geographically, we are spread all over the world. So you can see some of these dots. So pretty much we are spread all over the world. The corporate headquarters are in Dallas, but we have a major development office in India as well. So what do we do? And O9, we want to be the digital brain for business enterprises. Our core offering is a platform, and this is an in-memory cloud-based platform. It is built on a graph cube model. So the idea here is that the graph concept, it allows you to form these interconnections, as the picture at the bottom is showing, in a more natural manner. And it allows you to represent relationships between different entities a bit more closely. And then the cube model helps in aggregation, disaggregation. The platform is quite scalable. It is it has a Hadoop Hive base as well. And you're going to see some of the customers we have handled, like Walmart and others. So it's quite scalable. It has also a rich backbone around AI ML. So we offer various plugins. Some are generic plugins so that you can bring your own problem, model it within the platform, pass it to the plugin, and utilize the concepts there. But for some supply chain planning problems, we ship with some plugin capabilities already built in. So you're good to go. Right. So again, the core offering is the platform, but and the platform is quite flexible and quite scalable. So potentially you could use the platform for say finance or HR or any other business function as well. But supply chain planning is more in our genes. The founder, Sanjeev Sidhu, he pioneered supply chain planning way back in early 90s, even early mid 80s. And then a lot of people within O9 are in planning space. So that's why you see that in a way we use platform more for integrated business planning. The idea is that we want to transform supply chain planning, revenue, financial planning at global enterprises. And again, just a quick snapshot. So you're going to see some major customers here. So one advantage of being a platform company, it gives a lot of flexibility. So as you can see in this slide, we have handled customers like Walmart and Starbucks, more on the retail side, then brand manufacturers like Nestle. There's industrial manufacturers like Caterpillar. There are oil and gas majors as well, so quite flexible. And so I think the platform has proven itself well. And the graph cube model, it allows you to model data at just the right level of granularity. So when you're doing your planning, whether you want to do strategic planning, tactical or execution, the time horizon might be different, which may warrant modeling the data at a different level. And our platform, our enterprise knowledge graph, which is the core part of the platform, that's very well suited to it. And again, I won't go into the details of this. So for sure, you can reach out to me later. And Umesh, one of my colleagues within O9, he gave a session on this as well. So you can review that seminar. Again, the focus of discussion today is around inventory planning. So what you're going to see here is high-level offering from O9. So here we have the enterprise knowledge graph where you have the data, where you have these interrelationships between different models. And looking at this data and this knowledge, right, there are different things we have built. My core area of focus within O9 is around supply chain analytics. And within supply chain analytics, that in itself is a vast field. But what we'll be discussing today will be more around inventory optimization. Yep. So with that, let's get into the inventory optimization piece itself. And so at a very high level, right, what does an inventory optimization piece or what does an inventory optimization tool need to deliver, right? So it needs to come up with the right size and mix of inventory across the entire supply chain. So when I say right size, how much should I carry? Right? Is it 10 units, 20 units, 10,000 units? What's the right amount of inventory to carry? Mix of inventory, should I carry more of product A versus product B? Or should I carry more of finished goods versus raw materials? And where do I place this inventory across the supply chain? So do I carry this inventory downstream? Do I carry more upstream? Do I carry a mix? And mix as in both upstream and downstream. I carry inventory at a plant warehouse. I carry inventory at RDC. So I carry it across all echelons. And if so, I need to balance it, right? So I don't want to be carrying excess inventory. And typically, the key input parameters that go into the tool are forecast, lead times. That in itself, those are not unusual. Those are not going to come as a surprise to most of the people, right? But the key part to note there is that the forecast and lead times, they are in the rest of the supply chain planning space, they are more deterministic, right? So basically, you're going to do a forecast and say the forecast for April 2021 is 10,000 units for this item at this location for this customer. Similarly, lead times, right? So say supply planning, other areas of supply chain planning, they look at these parameters in a more deterministic manner. And the whole point in inventory planning is that, there is a forecast, there is a lead time, but we're not quite sure on what the forecast is or what the lead time is, right? So I forecasted 100, but hey, maybe looking at the historical data, I haven't been really good at forecasting this item, right? I forecast 100 and the actual turns out to be 150 or 80, right? And if you're under forecasting, then definitely you want to carry enough inventory so that you don't have dissatisfied customers. So similarly on the lead times, right? I expect the supplier to deliver this raw material to me in 5 days, but sometimes it takes 7 days, sometimes it takes 10 days, and I don't want my factory to stop, or I don't want to miss an order from an important customer because of this error in lead time or this variation in lead time. So the key part in inventory optimization, right, the whole point of keeping inventory is that there is an uncertainty associated with demand and supply. And to counter that uncertainty, you want to carry some inventory, right? So you don't want to have unsatisfied customers. You want to keep inventory so that under these uncertain conditions as well, you keep these customers happy. And then the flip side, obviously, is that you don't want to carry too much inventory either, right? Because that's a drain on your pocketbook. So those are some of the inputs, and demand and supply uncertainty is slightly unique to inventory optimization. And then the other key input is obviously the service level, right? So if you're okay, like, that your customers, your customers get a service level of 80%, then maybe you don't need to carry as much inventory as, say, in some other cases where your customers are quite demanding, and you need to carry 99% service level or 99.7% service level to compete out there. So we'll look at some of these in a little bit more detail in subsequent slides and in the demo. And just so that we are all on the same page, some of these slides you guys would be, or some of these concepts you're familiar with, but just so that we are all in sync here, I just wanted to align with some terms. So what you see here is the classic sawtooth diagram for ROP, ROQ policy. And what you see here is the actual inventory position, the inventory that is on hand. So you start with this inventory, and as the customer places a demand, obviously you satisfy that demand, so your inventory keeps going down. And in the ROP, ROQ policy, the idea is that if your inventory touches the ROP, right, then you place an order, and that order should be for reorder quantity or ROQ quantity. So here, your inventory touches the reorder point that has been previously established, and this is something MEIO or inventory optimization tool will help you establish. And as soon as you place the order, the inventory position, which is a sum of on hand plus on order minus back orders, it goes up, right? It goes up, but the actual physical inventory in hand that you have, it still hasn't caught up, right? So this order that you placed here, it's going to come a lead time later, right? So I placed an order today. If the lead time is 5 days, like, I'm going to receive this order 5 days later. Meanwhile, obviously, the demand keeps happening, right? So you're burning the inventory, and it keeps going down. And then as soon as you receive an order, it goes up. So what I'm going to focus a little bit more on is on the on-hand inventory, so that we are all aligned, right? So here, the on-hand inventory, it goes down, and this is the reorder point. There's a concept called a safety stock, right? So the idea here is the reorder point is the trigger point for placing an order, and this safety stock, this inventory, is the buffer that you keep for demand and supply uncertainty, right? So this is the extra inventory you're carrying, that in case this curve that you're seeing here, right? So there's a particular demand rate we are seeing, right? So I'm expecting a demand of 1 every day. But let's say that this product suddenly becomes a high seller, right? So instead of a demand of 1 every day, let's say the demand turns out to be 5 every day. So then this curve here, this line is going to be a bit steeper, right? And it's going to go down in a far more steeper manner. And in that case, you might have a stock out, right? So the whole point here is that I want to carry safety stock so that I don't have that stock out. And the key risk period for me to avoid that stock out is the lead time, right? So if within that lead time, I have enough inventory so that by the time the next order arrives and replenishes me, I have enough inventory, I have enough safety stock that I can counter any uncertainty happening either on the forecast demand side or on the supply side, then I'm good, right? So the key takeaway here, right? The inventory optimization tool is going to come up with reorder point, safety stock, and reorder quantity across the entire supply chain in a time-phased manner. And even out of these 3 parameters, which are key outputs for ROP, ROQ policy, there are other policies as well, but for sake of simplicity, let's stick with ROP, ROQ policy. So the key output that typical downstream planning applications from inventory optimization look for MEIO to provide is the safety stock, right? So, and when I say the downstream planning applications, so typically this is the link, right? So in inventory optimization, we're not generating a forecast. Right? That typically is a different function, typically maybe a different team as well. And in O9, we have a different offering here, sitting on the same platform, utilizing the same enterprise knowledge graph. Here I might be using an ML model, doing some of the statistical forecast, doing a consensus forecast, a bunch of other techniques. Ultimately, there's a final forecast that is generated. This final forecast forms as an input to inventory optimization. So that comes as an input. Other input parameters we briefly talked about in the previous slide, right? So the network structure, right? What my boards are, what my bombs are, what my lead time are, variability, those are other input parameters. And inventory optimization generates a safety stock and reorder quantity. Those are the key outputs that supply planning is looking for, right? So this safety stock that MEIO generated, this is the optimal safety stock that it thinks you should carry at this item at this location for the month of April 2021. That is an output from MEIO that goes to our supply planning piece. And in supply planning, all it is doing is it's doing the coverage job, right? It's trying to monitor what the current inventory picture is, and is it below the reorder point or above the reorder point? And if so, it needs to place an order and it needs to decide what the ordering quantity needs to be. Right? So that is the entire job of supply planning. So supply planning takes the safety stock as an input, looks at what the existing inventory is, what material is coming in when, what is the forecast, what are the firm orders, and then it says, oh, maybe I'm below my inventory position I need to be, what I should be, what the MEIO says that I should maintain. Maybe I need to place an order and replenish it so that I go above the level that MEIO is saying. Right? So those are the key outputs. There's a link between MEIO to SNOP as well. So a lot of times, as an example, in the COVID situation, people didn't know whether the economy is going to recover, and if it recovers, how much is it going to recover, right? So my forecast, I want to be prepared for a best case and a worst case scenario, right? So the best case scenario, maybe my demand is 10% higher than what I'm seeing, or 20% higher than what I'm seeing, and if the pandemic worsened, maybe it's going to go down, right? So the idea is I want to be prepared for that. And one of the key inputs there that people evaluate is that, okay, in the best case scenario, if the economy recovers quickly, we contain the pandemic, and the economy booms and the forecast goes up by 20%, how much more inventory would I need to carry and for which items so that I'm prepared? And also the flip side, right, that if the economy deteriorates, where do I need to burn the inventory or manage the inventory more? Right, so that again is an interplay between MEIO and SNOP, and I'm going to show that as well in the demo on typically what people do. Okay. So with that, just 2 slides on benefits, and then we go directly into the software. So again, some of this, obviously, all of you guys would be familiar with this. Inventory is one of the key parameters within an organization, anything good or bad happening within the supply chain. It manifests very quickly in terms of inventory, right? And it's one of those parameters that companies typically report in their quarterly earnings as well. I think if you can come up with the right inventory targets, right, then based on our experience, typically you see overall reduction in inventory, you see fewer write-downs, you see a reduction in expedites because you have placed the right inventory at the right place, so there's no firefighting happening at the very end. You also typically see an improvement in service level revenue and margin because you're keeping the right inventory for the right items, right? So you're stocking more of high margin, high revenue items, and there's a process to updating those targets as well. So typically that results in a better service level. And just to give you an idea, this is a kind of a screenshot from one of our customers. Tenant, in the sense that we implemented MEIO at a global customer, Fortune 500 company. And this screen that you're seeing is only the comparison of finished goods. So there's finished goods and packaging material, that's what they've modeled. So just for finished goods, before 2009, they were managing the inventory targets via some homegrown Excel sheets and tribal knowledge. And then 2009 came in, so more method to the madness, more establishment of process, more mathematical rigor. And what we are seeing is that compared to what they were previously using, which is represented by this green line, so these were the targets that sat in their APO. These were the targets that were hand calculated or calculated in Excel or based on tribal knowledge entered by the user through the UI. So we compared those targets, which represents this green line, with what MEIO is recommending for the same service level. And you can see roughly 50% reduction in inventory on an average. And this is in terms of units. But in terms of dollars, it's even more substantial, right? I think it was to the order of about $25 million reduction in inventory over a period of time. And this was only finished goods for one region of this global conglomerate, right? So this is, as they roll this out globally, you can imagine the savings that potentially they could have. So yeah, I think it is a very useful area of supply chain planning, and done well, if implemented right, results in a lot of savings. So with that, let's go a little bit more into the details. Let's peel the onion a little bit more. And I mentioned briefly as well that there are a bunch of inputs that impact the amount of inventory that you ought to be carrying, and MEIO is going to optimize it. So we're going to go into a little bit more detail in each of these, and I'm going to pull up the software as well as we go along. Okay, so let me pull up the software now. So
Asim, sorry to interrupt. I'm going to turn off your video. We're getting a little of choppiness in your audio, so I'm going to see if this is going to help if you're not having to try to share your video.
Sure.
Thanks.
Are you guys able to see my screen?
I am.
All right, excellent. Right, so this is our UI for 09 MEIO. And what you see is obviously it is web-based. And to the left is what we call as workspaces. So the idea is that our customers may have demand planning, supply planning, IBP, MEIO, a bunch of other applications from 09. And depending on who the user is and what permissions we have, we're going to have access to some or all of them. Right? I think the key takeaway here for showing this is that this is an integrated offering, right? So typically, you don't want to do inventory optimization as a one-off, right? As I showed in the previous slide, MEIO is going to require a forecast as an input, so the forecast should be good. And then whatever targets that MEIO is fitting, there should be something downstream that needs to digest those targets and execute to it. So in a way, it's a related problem. MEIO sits between demand and supply, and an integrated offering typically is better. But having said that, so in this particular demo, this is the network that we have modeled. So there's a plant here, and this plant, it has it has some raw material which it procures, and then it makes a finished good at this plant. So there is some manufacturing happening, and then we can stock some inventory at the plant. So there is a plant warehouse where you can stock inventory, and from there the material goes to this DC and then to these downstream nodes. Okay, so in this demo, what I'm asking the tool to do is to focus only on the finished goods for the time being. I'm asking it to generate what the optimal inventory target should be here, and then here, and then at each of these locations downstream. Right? Okay, so this is the demo. This is the supply chain we have. A few points, right? At the beginning, right, when I mentioned, I said that we have multi-echelon inventory optimization, right, solution. I said multi-echelon. So what does it mean to have a multi-echelon inventory optimization tool? Different interpretations people have around the concept, right, or basically different interpretations to the problem. But the key common thread there is that when you recommend inventory target at any of these echelons, whether it is here, here, or here, you make that recommendation taking a holistic view of the entire network. Right? So if I'm recommending a safety stock here, I should be aware how much inventory we are recommending here and here. If I'm recommending a ton of inventory here and here, then maybe I don't need to carry as much inventory here. Or if I'm not carrying inventory at these two nodes, I'm carrying no inventory at all, right? Maybe these are just cross-dock locations, right, as an example. So then obviously I need to carry more inventory at this location because this is the only place where we stock inventory, and this is the only place where you're going to buffer the demand and supply uncertainty to satisfy your customers, which are obviously here. Right? So that is the key concept. And there are different ways people tackle that. So one aspect is that people specify a service level just at this end node, right? You say my customer is looking for 99% service level here, 95 here, 99.8 here, so on and so forth, and let the tool come up with optimal targets here. Another way is, which is more practical, where people say, okay, you know what, the planner specifies a service level at each of these nodes, here, here, and here. But then when I come up with the inventory recommendation at any of these item location combinations, that recommendation is aware of what inventory is being recommended here and here. And as I mentioned before, right, if there's a ton of inventory already being recommended here and here, then I don't need to carry as much at this location and vice versa, right? And we're going to come to that as well. I'm going to show a scenario at the very end where the tool does exactly that. Okay? So obviously here, a network is one key input. We talked briefly about forecast, right? So in this particular demo, what you see here in yellow, week 19, 2019, assume that is the current date, right? So as of today is week 19, 2019. So the data here is a bit old, but the concepts are going to hold, right? And what you see here is a future forecast that came from a forecasting piece. It's the final consensus forecast. That consensus forecast might have been arrived at by looking at the forecast generated by the ML algorithms, by say sales and marketing input, or a bunch of other things. So ultimately, this is the final forecast that people believe in and they agree to. And this is the forecast for which we need to build a plan and for which we need to generate an inventory target. Okay. Here again, I think one key concept that the forecast that typically most of these forecasting algorithms generate, this is going to be only independent forecast, right? So this is the forecast here. So basically, we're going to say we sell 5,000 units of this item to Walmart and 50,000 to Costco, so on and so forth. But as I mentioned, we need to come up with inventory targets across the entire supply chain. So I need to generate a target not only here, but here and here as well. So there's a process which we have enabled within the tool where we do a dependent demand calculation. So this independent forecast is propagated all the way upstream using the BOD and BOM conversion. And so when I say this forecast, even though we got only independent forecast, you're going to see dependent part as well. It is doing the dependent demand calculation also. Okay? So that's one part. Then I mentioned that this forecast, obviously, there's an uncertainty associated with this forecast, right? So, and that is a key input which MEIO needs to consume to come up with the safety stock target, right? So the whole point of carrying inventory, or at least one of the key points, is there are other aspects as well when you carry inventory, like it could be I want to do an anticipation buy or something else, right? But one of the key parameters here is that you're buffering against demand and supply uncertainty. And that demand uncertainty, there are different ways people suggest that what should be fed in MEIO. The one that we believe in O9 is that you look at the forecast error, you look at the weighted mean absolute percentage error. So the idea is you compare the forecast with actuals. That helps you realize how good or bad you are in terms of forecasting. And if you're terrible at forecasting for item A, then obviously you need to carry more inventory because most likely you're going to be off. The actuals are going to turn out to be very different than what you're expecting. And if you're really good at forecasting item B, then maybe you don't need to carry as much inventory. Some people also say that instead of weighted MAP, you can use historical standard deviation. I myself, based on practical experience, am not as much in favor of that, but you will encounter that as well. So all you do in that case is you look at the historical actuals and see what the deviation is. And some people use a combination of the two, right? So they might say that for some items, maybe say use the max of whatever comes out, right? Whether the error or the standard deviation, use the max so that you're conservative. But within O9 and from my prior life, weighted MAP is a more practical approach, which has given us better results. So that weighted MAP, again, is something that MEIO calculates. And here, if you see, in this case, we have fed the tool the historical forecast and actuals. And obviously, it's taking a look at the historical forecast and actuals. So this yellow dot, again, is the current date. To the left is history. To the right is the future. It is looking at this part of the data, and it is coming up with an error. And again, the key concept is that you come up with a forecast error, that forecast error needs to be calculated for each node within the supply chain, because if we're going to come up with a safety stock target for the plant, warehouse, and DC, right? So that network that I showed, right? It's not that I'm just looking for the forecast error here, right? I want to calculate a forecast error here and here as well, because I need to generate an inventory target at these nodes as well. And our solution, it will do that. So what it does is it propagates the historical forecast and actual from these guys upstream, just like we do dependent demand, and then we regenerate a waterfall here and here, the forecast waterfall, and it is going to compute the weighted MAP here at these two upstream nodes as well. Another key concept here is that when you calculate weighted MAP, the question comes up, I'm generating a forecast every week or every month, and I've generated a forecast today, as you're seeing in this slide, right? So basically, we generated a forecast in August 2019 at a monthly bucket for the next 12 months, and this is the forecast. Then I generated a forecast again in September for the next 12 months, and this is the forecast, similarly in October and November. So if I'm looking at November, right, the forecast that I generated in August, it will have a different error when I compare this forecast with the actuals that happened in November versus if I compare the forecast here with the actuals. So basically, the question is which lag you should be using. And again, this slide is just showing that obviously there are actuals here. And in this case, like in the August cycle, we generated a forecast in August for 144, for September 104. Similarly, the September cycle in September, so September 1st, we set that the forecast for September is 113, 114 for 149 for October, so on and so forth. So the question is, which of these lags should you be using? Should you be using a 1 week lag forecast to compute the weighted MAP, lag 2 forecast, or lag 3 forecast? And the right answer there is that typically you want to look at the lead times between the nodes. And this lag should correspond to the lead time because that's your risk period. And in the O9 tool that we have, right, you can either specify this lag manually. So when I say specify this lag, as in you can say that if this lead time is 3 weeks, then I want to calculate the weighted MAP here with the 3 week lag. If this is 2 weeks, I want to calculate it with 2 week lag, and here 1 week lag. You can do that, or the tool can also auto calculate and recommend that you should be calculating here with lag 3, here with lag 4, so on and so forth. And the tool will do that, and it generates this forecast error across the entire supply chain, right? And again, typically, you might be aware that as you go up the network, the forecast error here, and if you compare the forecast error at this echelon versus this echelon versus this echelon, the error as you go upstream, it usually goes down, right? Because when you compute the error here, you might have over forecasted this guy, under forecasted this guy, over forecasted here, under forecasted here. By the time you get here, I think things would have balanced out a little bit. Okay, so that is another input. The third input that we want to talk a little bit about is the lead time and variability. Right, so I mentioned other uncertainties around the supply side. And this again, the lead times typically people know, but sometimes even those lead times we find in our customers' data set, they are a bit off when compared to reality. So we have some analytics built in where what we do is we look at the actual transactional objects within the supply chain, and looking at those individual transactions, we come up with what the observed lead time is, and then we have built a machine learning model to be able to even predict the lead time in some cases, right? So as an example, and this is what I'm going to show you in a little bit, we can take a look at the procurement leg, right? And in the procurement leg, I place a order today and I get the goods 2 weeks from now. And if I can keep track of all of these POs, say for the past 2 years, then I can look at the turnaround time that this vendor has for this item and look at the average lead time variability, so on and so forth. And similarly, you can do for the STOs and production orders as well. And I'll cover just one more slide here. So one part of it is the observed part. And then the second part of it is we have an ML model built in as well, where the tool can be trained on the historical data. And looking at some of the features, these are some core features. It can make a prediction of the lead time for the next 12 months. So it can say that this item, when you procure from this vendor, for April, expect a lead time of 23 days. For June, expected 40 days, so on and so forth. And I want to just very briefly show that as well. Yeah, so in this particular case, what we've done is, right, here what you see is there we have within the O9 platform, we have gathered the data. This is actually kind of data derived from one of our customers. So they provided us purchase orders going back past 2 years, right? And looking at each of those individual transactions going back past 2 years, we come up with what the observed lead time is, what the outlier corrected lead time is, and the outlier corrected lead time deviation is, and also an ML predicted lead time and the error associated with it. So let's go a little bit more into the observed lead time. So here, for between this supplier 6 and plant 5, for this raw material 1422, the tool has looked at all the historical transactions. And what it is saying is, like, the histogram at the bottom is saying is that there are some transactions that are turnaround time of just 6 days. And then there are some transactions where the turnaround time was 216 days. A vast majority of them, though, look to be between 20 to 40 days or so. Right, so that's what it is showing. And actually, I can click on each of these individual transactions and see whether indeed that was true. So it is saying, as an example, this particular PO, it was placed on 6/29, and we received the material on 7/5. And so the turnaround time was 6 days, and basically that's what it is showing, this 6 days. And there was one transaction where it just happened, the turnaround time was 6 days. Looking at this data, and I can come up with the prediction. So what you see here is to the left of this line, right? These two lines there, the observed lead time and the outlier corrected lead time, month by month. And what you see to the right is the prediction by the ML model. So in this case, we use the features that I showed in that slide, and I won't go into more detail. But basically, the model was trained on data for 2019. And that's why you see, even though here the lead times are quite large, the prediction is a bit smoother and lower. The reason was that, at least the way this demo data is being portrayed, is that we trained the model on the 2019 data. The 2020 data was COVID impacted, right? So according to the customer, maybe for now at least not a good data to take a look at. So we trained the data on 2019 data, and the first 3 months of 2020, when the pandemic hadn't fully hit, we used that for testing, right? So, and that's what you see, right? So basically, this is the prediction, and that error that you saw, which I was showing in the previous screen, this error of 16% was how accurate the prediction was on the test period. So again, I think the key concept here is that for MEIO, we're looking for lead time and variability. And you can take a look at either this outlier corrected lead time and variability and feed it to MEIO, and it will consume that as an input. Potentially, you could go via the ML route as well. But typically, this is, for the timing, the more common way of bringing in this data. Okay. So that is another input that goes into MEIO. And then the other important input is around service levels. So the service level at each node, we are looking at the demand and supply uncertainty. But if you're okay providing 0% service level to a customer, then really you don't need to carry any inventory, right? You don't need to carry any additional safety stock. Like you have customer places in order. Everything is back ordered, you could say build to stock or build to order. You can go down that route as well. But typically what people do is they'll do some kind of segmentation, right? So you might want to say, I want to classify my portfolio. So my high margin, high volume, high revenue items, those are important items. And maybe I want to run those at 99.7% service level. Low margin, low volume, low revenue items, I'm not too worried if I don't offer a good service level there. So 90% is fine or 95% is fine. And that's what you're seeing here, right? So in this particular case, we are saying A items need to be at 99.7% service level. B items at 99, C at 98. And this classification of items into A, B, C, that also the O9 platform can help you do that. This classification people typically do based on rules-based segmentation. So the idea is that you pick some attributes like margin, revenue, and volume, and you would say my high margin items are ones where the margin is say more than 70%. High revenue items are the top 10 percentile in terms of revenue, and so on and so forth. And then you combine them, and the tool can then classify to say item 1 at location 1 is a A item, the same item in location 2 is a B item, so on and so forth. And the user comes into this screen and just sets a service level of 99.7, and all item locations that belong to A, as an example, they're going to then inherit the service level, right? So this item, 48,100 at this location, it inherited that 99.7% service level, and the service level can be time-phased as well. Right? Okay. So, but now I think from a theory point of view, right, when we say 99.7% service level or 95% service level, what exactly do you mean? And there are two ways people measure it out there in practice, right? So we call them as service level types, and you're going to hear different nomenclature for that. One is called probability of no stock out. So the idea is that you recommend enough inventory that there is a low chance of stock out, right? So if I say that the service level is 95%, then the idea is that you recommend inventory that there's a 95% chance that there is no stock out. That means the demand during lead time, there's a 95% probability that it's going to be less than whatever inventory you're carrying. So you're going to be fine. 5% chance maybe the demand that happens during the lead time is far larger than the inventory that you're carrying. In that case, you're going to have a stock out. The second service level measure is called fill rate, right? And the idea here is it's not just a question of stock out, right? But it is also that if I have a stock out, what is the magnitude of the stock out, right? Is it a stock out for 1 unit, or is it a stock out for 10,000 units? And in that second service level measure, mathematically, we try to compute the back order. So the idea is that if the algorithm is recommending 100 units of inventory at a particular item location, it says that looking at the forecast, looking at lead time, looking at the lead time variability, looking at the forecast error, it generates a probability curve. And then it says that, okay, if I recommend 100 units of inventory, there's a probable, based on probability, I'm going to expect a back order of 5, right? And how does that 5 compare to the demand during lead time? And if my demand during lead time is 100, then yeah, I'm 5 back order. That means I'm going to most likely satisfy 95% of the demand. So that is called as fill rate. Again, the key point here is that, just one more slide. Right? So when I say, in this case, the probability of no stock out, which is a little bit more easier to grasp, underneath what the algorithm is doing is it is taking a look at the forecast, lead time variability, forecast error, and generating a probability curve at each node, in this case, normal. Right? And then if we say that we want a 95% service level, it is coming up with a reorder point such that the area to the left of this reorder point covers 95% of this curve. Right? So that's underneath what it is trying to do. And I think when we talk about the two service levels, I think the easier way to understand this is, as I said, the first one, all it says is what's the probability you'll have a stock out. It doesn't try to quantify the stock out. The second one will try to quantify the stock out as well. So if you take a look, in this case, let's say there are 3 items. They have exactly the same forecast, 100, but the deviation or the error around them is a bit different, right? So this guy, I have a bit more accurate forecast. I'm able to do a better job, so the error isn't quite large. This one a bit worse, this one quite worse. So here, if I recommend keeping 100 units of inventory, the probability of no stock out will always say 50% service level, because there's a 50% chance that the demand is more than 100, 50% chance that there's a demand of less than 100, right? So 50% probability that you'll have a stock out, 50% you won't. But what it doesn't know is that, okay, if there's a stock out, is the stock out really bad, which is going to cripple my business, or no, right? We're not trying to quantify that. The second measure, fill rate, it will try to quantify that, right? So it will say that, okay, if I do have a stock out, is the stock out for 1 unit or 10,000 units? And then obviously in this case, the curve here at this item, it knows that if there is a stock out, that stock out could be quite bad, right? And in this case, it won't recommend a 50% service level. It will say that if you keep 100 units, maybe your service level is going to be a bit lower, right? So that's what it is trying to do. I won't go into the details of this math. This slide would be available to you, but this is more from literature. So as I was saying, the tool underneath takes a look at the forecast lead time variability. So this is an equation which is quite popular out there. You can Google it as well. It again comes from smart academicians like yourself. So we just adopted those equations, and these have been known for years, so a couple of decades at a minimum, right? So the key point here is that from a business point of view, the users do some ABC classification, as we saw. They set a service level, and when you set that service level, you need to have an idea what kind of service level you're setting. Is it fill rate or probability no stock out? And each business typically tries to follow one or the other, and that's what they will go with. Okay. A couple of other input parameters I want to talk about. Cost is another one, right? And the cost that we consider are unit cost, fixed setup cost, holding cost, so on and so forth. And you're going to see some of that come up in a little bit as well, right? How we use it. So that is another input. And finally, I think, as I said, the tool also comes up with the economic order quantity or reorder quantity, right? And this is the classic EOQ formula. So it is taking a look at the order cost, the holding cost, and the carrying cost. But the important point here is that as the calculated economic order quantity goes high, the amount of safety stock you need to carry lowers. Right? So in a way, if you're going to place an order with a vendor for 1 million units, then just placing an order for one order for 1 million units might cover you the entire forecast and any uncertainty that happens around that forecast for next 1 year, right? So in that case, you don't need to carry any more inventory on top of that. And that there's more math underneath where it tries to balance it, right? So the tool is aware of what the ordering quantity is, whether it is calculated or user specified, and how much to lower the safety stock in case that ordering quantity is quite high. All right, I'm just doing a quick time check. So yeah, I think those are the inputs, and now let's go a little bit more into the outputs, right? So typically you would have, the way this thing works is people, in my experience, they run MEIO, say, once a fortnight, once a month, once a quarter. Once a month is typically more typical. So you set up all this input data. That usually is a data feed. And once that input has been provided, you run MEIO. I'm not going to do that here for the time purposes. But once you run MEIO, it looks at all the maths that we talked about in some of the previous slides, and then it spits out the results, right? And there are two kinds of users who are primarily interested here, right? So in this case, we have run the solve, and it is spitting out these results. So one type of user is a super user, right? So this would be someone who wants a bigger picture, more senior management. They want to know that what is the inventory I'm going to carry, either in terms of units or in terms of dollars, based on the service levels I've set. Right. So in this case, we did some ABC classification, which set some service levels there. The tool obviously calculated the forecast error, calculated the lead time variability, so on and so forth. Ultimately, what it is saying is that across the entire portfolio, you need to carry some 1.6 million units of inventory across all items, all locations in this week. And it's worth about $6.5 million. That's just the safety stock. I can also see a split of that safety stock by product and by locations, right? So it is saying that my premium items are going to carry this much. And again, I can take a look at it both in terms of units and dollar value. And in terms of by location, it is saying in this particular case, we're carrying a ton of inventory at the plant warehouse. And again, I can take a look at it both in terms of units and dollars. Right. So in this case, because I asked the tool, I gave it the flexibility that a plant warehouse is stockable. So it thinks like, I want to stock more at plant, and that actually you're going to see a lot of these inventory planning tools do. Right. So the idea is there's a concept of postponement or kind of pooling inventory. Right. So if you can stock more inventory upstream, that typically is better for a few reasons. One, because here it is a bit cheaper. Right, if you're carrying inventory in raw material form, or even here, you haven't shipped the inventory, so you haven't incurred those costs. So it's better if you can stock inventory more here, and then you're able to respond, right? So if this part of the supply chain sees a lot of demand, then you move inventory here. If this guy sees a lot of demand, you move here. So you have a little bit more flexibility. right? So typically, most of these algorithms, they have a proclivity to recommend more inventory upstream so that you pool inventory upstream, and overall across the supply chain, that typically results in lower inventory targets, right? And in this case, we saw that at a high level, the tool did that. Right, so these kinds of reports are good when you're doing scenario planning or some senior management folks are looking at it. And I'm going to show some scenario planning capabilities as well in a minute. So, but this is a high-level report, right? At a planner level, or in, say, when you feed the targets to supply planning from MEIO, you want to know the targets at each individual item, location, time period combination. And this screen is more relevant to the planners. So here what you see is the tool has run and it has recommended a target for this item across all locations within the network where this item is carried for this bucket. And it is recommending this safety stock target. You will also see to the next of each of these, there's something here. It says recommended safety stock. Here it says recommended safety stock LC. LC means the last cycle. So as I mentioned, you would say run this every month, right? So every month, maybe a new forecast has come in, maybe a new item has come in, maybe some lead times have changed, maybe some sourcing networks, I'm now procuring this item from supplier 6 instead of supplier 5. So supply chain has changed a little bit, and you want to have updated targets based on that. So what we do here is that we compare the target at each and every item location combination with what the target was in the last cycle, right? So now if you're a planner, say if you're at Walmart or one of these big companies, you might have millions of these item location combinations. So obviously no one has the time to come and take a look at each of these combinations every month to say, hey, what happened here? So typically it's management by exception. So we'll try to bubble up to the planner only those instances where there's been a dramatic change in the target from last cycle to the current cycle. Right, so that's why you see some of these conditional formatting, right? And when I say a dramatic change, the users define what a dramatic change is. In some businesses, 10% change month to month might be quite dramatic. In other businesses, maybe not so, right? So maybe they might say, we require a manual intervention only if the target changes 40% between last month and this month, right? But the idea is that it's comparing the target between last month and this month. And then we bubble up only those exceptions where there's been a dramatic change to the planner. And when the planner comes in, right, so most of the planners, they don't have the time to go through all the math and figure out why the target changed, and they don't want to go in those level of details. So the question to them would be, okay, why did the target change here, right? What happened suddenly within a month for the target in this particular case to go from 970 to 1081? And in that case, what you've done is, so some of those inputs that I was talking about, we try to bring those to the planner's attention. So we say maybe forecast error might have changed. In this case, really, that wasn't the case, right? The forecast error pretty much is the same. Maybe the lead times would have changed, and really didn't change in this particular case. So the lead times are roughly the same as well. But yeah, actually the forecast did change, right? So last month we were forecasting some 1900 units here. Now we are forecasting some 2100 units. So yeah, indeed, there's a change in forecast, which might warrant me to carry more safety stock. And yeah, the planner will take a look at it and say, yeah, okay, that makes sense, right? Yeah, the forecast went up. That results in a higher safety stock. I'm okay with it, and no worries, right? Or alternatively, in some cases, the planners might know a bit more, and they might say, you know what, this forecast I don't trust. I talked to some of the people, it doesn't look right to me. We're going to revert. We're going to look, continue with the old target. And in that case, they can manually override. And these targets that we generate, they are targets generated both in terms of units, so 1081 units of safety stock, and also in terms of buckets or days of inventory, right? So we generate both, and our supply planning solution is capable of digesting either in terms of units or days or a combination of the two, right? So this would be what a planner would do month to month, right? Now, at the beginning of the slide beginning of the presentation, I mentioned there is an interaction between MEIO and SNOP as well. And that's the one I'm going to talk briefly about. So the idea is that when you're doing a lot of times people want to do what if analysis. What if my forecast went up? What if my forecast went down? So that was the example I was giving as an example during pandemic, right? So one of the questions people tackle in SNOP would be, what is my right goalpost and my left goalpost, and whether I'm going to be fine in either of those two cases, and what do I need to do to be prepared for it, right? What is going to be the impact, right? And one of the key parameters to take a look at is that in either of those scenarios, how much inventory would I need to carry, right? So here, what we have done is we have built a screen that for some of those input parameters that we talked about, the user just comes in, punches these numbers, 95, 105, and 100. So I'll explain what it means. So the idea here is, in this particular demo data set, I have about 75 items, some 400 items, 75 locations, and we're planning for 52 weeks. So if you do an item location time period combination, actually this demo is running off 500,000 intersections. All 500,000 of those intersections will have a forecast, right? And that forecast would be very different, right? So this item at this location for week 1, the forecast is 10, week 2 is 20, the same item, location 2, some completely different forecast. So what I'm saying here is in this first row, I enter these 3 values. All I'm saying is take the baseline forecast, go 95% of that baseline forecast and create a scenario. Create a second scenario, which is just a baseline, so the forecast as is. And a third scenario, which is 105% of my baseline forecast. So go all intersections, just multiply by 105%, and whatever that forecast is, calculate inventory targets associated with that 105% forecast. So 5% jump in the forecast, and I want to evaluate the results. So similarly, I can do it for service level as well, right? So sometimes you're curious, hey, what if I raised my service level by 2 points or 3 points? How much more inventory would I need to carry? How much does it cost? Right? And am I going to be able to afford that? Right? So those are the questions that people try to ask. So you enter these values, you run a solve here, and then the tool understands that you're asking it to do a scenario analysis. Right? So in this case, as an example, it has run and it is saying that, say, for this item across all locations for this week, if we were to stay at the baseline, you'll need to carry some 3,600 units of safety stock. If the forecast went up by 5%, you'll need to carry some 3,772 units of safety stock. If it went down by 5%, then you'll need to carry only 3,400 units of safety stock. And then obviously what the cost impact is, right? So I can take a look at the cost impact as well, right? So if we went up by 5%, right, then the cost goes up from $1,430 to some $1,500 or so. And this one, I'm doing it only for a single item, but obviously if you pick all the items here, I can pick all of them. And if I apply, it will do that calculation for all at the aggregate level, at the portfolio level. So at the portfolio level, it will tell me that if the forecast went up by 5%, in that scenario, you need to carry $20 million more worth of inventory. And these are the items where you need to carry more inventory. You can go into that level of detail. Similarly, a similar concept on service level. So if you raise the service levels, you start from this baseline, you lower it by 5%. This is the inventory you need to carry. You go down by 10%. This is the inventory you need to carry. So you can do this kind of what if. And this goes as a feed in to SNOP. Again, this not something that you'll do each and every time, but a lot of times people are interested in these kinds of scenarios. Okay. Now there's a final thing I want to show you, and then I'm done with the presentation and the talk, and then maybe we can open it more for questions. So the final thing, right, I talked a little bit about the concept of multi-echelon optimization and all that part, right? I was saying, so the tool generated these targets. I'm saying that when it generates these targets of 1,081 here and 630 here, it is looking at this entire network. And it is saying that, okay, this item flows here, and maybe I recommended a lot of inventory here. So that means I don't need to carry as much here. So 1,081 here, only 500 here. And this 500, obviously if I was carrying nothing here, then maybe I need to carry more inventory here, right? Because if I carry nothing at the plant, then anytime this guy places an order on the plant is going to say, I don't have any inventory. You got to wait, right? I'm going to manufacture this item, or I'm going to procure this item. And then we're going to incur this lead time as well, right? So if this lead time is 3 weeks and this is 1 week, and the plant is carrying absolutely no inventory, then the total lead time is roughly 4 weeks. Or if the plant is carrying a ton of inventory, then every time this guy places an order, the plant has something on hand and it can say, I'll ship you immediately, right? So in that case, the lead time that this guy sees is just this lag, right? And that kind of intelligence is inbuilt within the algorithm. And one of the ways to show it is that I think in this scenario, as I was saying, we're carrying a ton of inventory at the plant. So let's just say that I decide not to stock any inventory at the plant, as I was saying in my previous comments. So one way to do that is that you say that I'm going to carry no inventory at the plant, and roughly you can say, let's have a service level of 0%, right? So what I've done is I've created two scenarios. So we had the baseline where we were stocking a lot of inventory at the plant. I've created one more scenario, which is called no stock plant, right? So what I'm saying is, in this case, I'm going to say we're going to carry absolutely no inventory for any item at any plant, right? And there's just my curiosity. A lot of times this is an important question in network design as well, right? So whether you expand storage at a location or you're shutting down a facility or you're doing something else, those kinds of questions come up. But I'm using it to illustrate the multi-echelon aspect of this particular piece. So what I've done is that in the baseline, we set a service level of 99.7 at the plant for this item and all items. In this no stock scenario, I'm saying keep service level 0. What that means is, obviously, to achieve a service level of 0, you don't need to carry any inventory. So the tool is not going to recommend any inventory. But that is going to have some consequences, right? And let's see what I mean when I say we'll have some consequences. So in this case, what I'm going to do is we are comparing the two scenarios, right? So this baseline scenario, as you can see, we are carrying some 1.6 million units of inventory for $6.5 million. But in this no stock plant situation, where all we did was we set the plants to 0. We said no stocking at the plant. The total inventory in the network went up to 2.3 million units or so. And roughly, we're going to carry 9 million worth of inventory rather than 6.5. And another interesting thing to see. So it is comparing the two scenarios side by side. So this purple bar is the baseline and the green bar is the no stock scenario. And it is comparing the inventory we're carrying at the two locations. So obviously in the baseline scenario, we're carrying a ton of inventory at the plant, where in this new scenario, it is 0 because we kind of forced it to say, we don't want to stock anything. Maybe there is no storage I just manually override it, 0, right? That's what we want. And that's the only change I did, right? So in the entire network, in the entire input, I didn't change the forecast. I didn't change any service levels anywhere. The only thing I did is that I changed the service level at the plant. I didn't change service level at the DC. I didn't change anywhere downstream. And what the tool did is that obviously because it is carrying no inventory at the plant, now because of the multi-echelon nature of the problem, the tool knows that at the downstream locations, there's a higher risk profile, right? And to counter that higher risk, it needs to carry more inventory. It needs to recommend more inventory downstream. So that's why you see that the inventory is going up at each of these downstream locations, right? So it goes up, and it goes up quite a bit in this particular case. Another important point to note here is that it's not that it just took this 1.05 million units and then it says, oh, okay, we don't need to carry anything at the plant, so I'm going to take this 1.05 million units and allocate it to the downstream nodes. No, what it did is that because we're carrying nothing at the plant, it evaluated the risk profile for each of these locations afresh. And it knows that, if the plant is carrying nothing, then the risk at the DC goes up. And it evaluates the new demand and supply uncertainty there and comes up with the inventory required to achieve the same service level at the DC as we were trying previously, right? So to put it in a different way, right? So just to take a look at the network again, right? What we were saying was previously we were stocking here, here, and here. Now we are saying stock nothing here, right? So the tool knows that, okay, if you're stocking nothing here, then the risk goes up here and here at each of these nodes. And it is recommending more inventory. And it's not just that it takes this 1 million from here and allocates it here, and downstream, right? At each of these nodes, it reevaluates what the required inventory is for the same service level, and then it recalculates and makes a recommendation. And the fact that the inventory went up in this second scenario from 6 million to 9 million, the reason is, as I was saying previously, right, if you can carry more inventory upstream, typically in a case where there is more branching happening, right? When I say branching, as in this guy branches off to 2, and then from here, there's further branching. If there's branching happening, if you can carry more, typically better strategy is to postpone inventory and do risk pooling. So you stock more upstream. And the idea is that, okay, if there's, if this guy overperforms and this guy underperforms, then you can easily move inventory from here to here. And overall, that means that you don't need to carry as much inventory across the supply chain. And that part is implicit within the algorithm, and that's what it tries to honor. So that's what it is trying to show. And again, this is an interesting what if. It ties into network design as well. A lot of times people do these kinds of what if to see, like, what if I change my stocking strategy, or what if I procure some additional storage at a plant and, like, something adjacent to the plant, is it beneficial? Right? Is the savings in an inventory that I'm going to achieve, are they good enough to counter any additional procurement of this warehouse space that I may need to incur? So those are what ifs that people like to do once in a while. All right, I think that was my prepared content. I will take a pause here. We can open it up for questions. I know there's a lot of material covered, but the intention was to convey some of the key concepts, tie it with the theory that you would have been reading in your books, and how we tie it in the software and how our customers are using it.
Great, thank you very much, Asim. And in the interest of time, I think I'll turn it over to Andy to moderate some Q&A.
Sure. Thanks, Alan. And chime in if you want.
Sure.
Alan had a question towards the beginning of the presentation. In the demo, your examples show a tree distribution network where downstream locations are served only by single upstream locations. Does the MEIO software also handle non-tree networks where downstream locations can be served by multiple upstream locations?
Absolutely, right? So this location could have been sourcing material from this guy and this guy, right? So it could be dual sourcing that is supported. And in that case, if it is dual sourced, then typically what you would want to do is you would want to give us the split that I go 80% to A, 20% to B. And that split is something that potentially we could calculate looking at your historical data, or is something you can provide as well. Normally, just to add on to that question, right? If you are dual sourcing, like in this case, I think this guy can procure material from here, but say there's a link between this guy and this also. Typically, unless it's a network strategy, people typically go to the lowest cost route. That would be an output from network design, and there's a primary, right? So the idea would be that my primary is this guy, but hey, if this doesn't have it and I'm in desperate need, then go to this guy. The way MEIO works, if that is the situation, right, that if this is just your secondary, it's not that you always source 80-20, it's just that this is your secondary, you go there under extreme situations. Then the idea would be that you run MEIO, and MEIO takes a look at only the primary route. And the reason being that if you take a look at the primary route, then MEIO comes up with the right inventory at each node, so that that entire need that you have to go to this secondary guy is obviated, right? So I should carry enough inventory here that anytime I need anything, I have enough. And if I need to procure something, I go to my primary route, right? The fact that you went here was because you didn't have enough inventory here, and neither did this guy have. So, you don't want to plan for that kind of situation. You don't want to plan that anomaly that you go 20% of the times to this guy under extreme situations to be propagated going forward, if that is an exception, right? So the short answer, technically, yes, you can model it. From a business point of view, if that is the real reality, right, that maybe this guy can only provide, it has some material constraints or capacity constraints and can ship only this much to this guy, and by necessity you have to procure other 20% from there, then indeed that's the way you need to model. But otherwise, a lot of times in our experience, right, if you look at the historical data, people might have dual sourced or triple sourced just because it was an exception and they wanted, it was a more firefighting mode. And there, in that case, then you shouldn't be showing that to MEIO. MEIO would ignore any alternates in that particular case and say, just go to the primary.
Okay, great, thanks. Our next question is, could you share more on what are the deterministic data features O9 selected to forecast demand in inventory?
Yeah, that forecasting piece actually is a whole, I think if I get the question right, so to come up with the forecast in itself, that's a whole different topic worthy of a session in itself. But I will point you guys to some of our videos. I would say just go to the O9 site. There are some videos where we show how we do ML-based forecasting, right? So as an example, for a lot of our CPG accounts, obviously we take a look at the historical data. But in addition to historical data, we may also be able to look at what your promotion has been, what kind of discounts you have been offering, whether it is a weekend, whether historically there have been some events that happened at a particular location, right? There was a big game that was happening. So there are a bunch of other features that we can take a look at, and the tool looks at the historical data. It does feature importance. It figures out that, for this particular item at this location, this is the feature that is driving more of your forecast. Right? And it takes a look at all of that and then comes up with the AI/ML-based forecast. I know it's a very high-level answer, but the short thing is, I think whatever you can think, I think our ML model can digest. There are some that we offer out of the box in the sense that, let's say that your forecast is impacted by weather and temperature, right? So within O9, we have links to weather.com where we can fetch the data for you, right? Let's say that your forecast is impacted by consumer price index or consumer confidence. So we have a knowledge hub where we store that data as well, that for this, this is for this nation, this is the consumer confidence, or it is impacted by the market size, right? So if you're manufacturing tires, right, maybe the auto sales have a bearing, and then your market share within that also has a bearing. We can take a look at all of those, right? So I won't be able to go into all of all of those details, but that is an excellent topic for a presentation in itself. And one of my colleagues, Nitin Goel, he handles that entire area.
Okay, great. A follow-up question is there any long-term forecast function in the software? And if there is a long-term forecast function, what are the differences of the forecast methods and algorithms between short-term and long-term inventory and demand forecasts?
Yeah, no, I think the forecasting, we can go either way, right? In the sense that indeed there's a long-term and a short-term forecasting horizon, and we can generate. So typically for the inventory optimization piece, the forecast is typically longer term. So put it in a different way, right? Typically what people do is that it's a 52-week kind of horizon, and this forecast is provided by our forecasting piece, the forecasting planning application. It will generate a 52-week forecast week by week going forward. Most of our customers would go down that route. There's a very short-term horizon as well in some cases, like you're looking at, say, next 3 weeks, right? So if you are in retail, right, or even other places, you might have a need to come up with inventory targets for the short-term horizon as well. Those would be slightly different. The way to calculate that would be slightly different. So the short answer is that the forecasting part, yes, both long and short term are supported. Even from an inventory point of view, both of them are supported. But typically in our experience, right, the longer term inventory planning is a more mature field out there in our install base. We can do the shorter term as well. And that obviously is going to look at the forecast that is, say, generated within the next 3 weeks. We can take a look at the daily forecast error, right? In this case, I was showing the error that came up. This is a kind of based on the weekly forecast, comparing the weekly forecast to the actuals. For a shorter term horizon, you'll need to take a look at day-to-day variations, and then it'll come up with that. Right. So it will look at, in that case, typically the difference would be that rather than the forecast being at a weekly level, you will have a daily level forecast. So 21 days at a daily forecast, you will come up with the error, which is day to day. And in a way, the concepts in terms of algorithms after that, the probability functions and all those would stay steady. Those stay the same.
Okay. The next question, for calculations like lead time, inventory order and stock out, forecast, etc., they all have different algorithms and approaches. Even though the platform has chosen the optimal one, is it possible to let users set their own preference to best fit their needs?
Absolutely, absolutely. Yeah, I think, and that is one advantage of the platform. So what we have, as an example for this inventory planning piece, this is built on Python, right? So the platform allows you to have a Python plugin. And I think what we offer out of the box is fairly robust, which meets the needs for a lot of our customers. But indeed, there are some of our customers who might have really strong data science teams who would have generated some homegrown algorithms whether it is for inventory or for anything else, or even for forecasting, right? They might have generated some homegrown algorithms which they're happy with, right? And in that case, absolutely no problem, right? You just need to create that, bring in that algorithm into the O9 platform via one of our Python plugins or our plugin, and it's just you just swap out what we have out of the box with what you want to use. So that's definitely possible, and that's one of the powers and flexibility that platform offers.
Okay. An attendee mentions I used an APO system. I'm assuming that's Advanced Planner and Optimizer system in my past work. The APO also has the tree distribution network calculations. However, it seems that the EMEO safety stock is lower than APOs. Can the safety stock meet service levels in real cases?
Yeah, no, good question. I think so. The question is that we are recommending a lower service level, right? That particular example, that customer was doing some Excel calculations and some tribal knowledge, and those were the numbers that we were using, right? Compared to that, MEIO recommendation was much lower at for the same service level. And indeed, it's a very good point, right? You recommend a lower safety stock, but if that safety stock doesn't deliver the service level that you're promising, then it's no good. So there are 2-3 things there that I would comment, right? One, and that's typically a change management question that comes up quite often. One, we can measure the achieved service level for you as well, right? So we can say that, okay, you came up with these inventory targets, you, over a period of time, use these targets, what are the achieved service levels? And if those achieved service levels are very different than what you were targeting, right? So in that particular example, we were targeting 98% service level. So we ran MEIO with 98% service level, like, for a majority of the items. It says you need to carry 10 days of inventory and you should be able to achieve 98% service level for this item at this location. And maybe in reality, you're not able to achieve that, right? So then it's a kind of a feedback loop, right? Then you need to take a look. One, either did the data that was modeled correct? Right? Is the data that was modeled correct, right? Maybe the lead time, as an example, we're assuming 5 days. Is it really 5 days? And a lot of times, like, I was showing you that we calculate the lead time from historical data. People don't have that historical data, or like, the beginning phases of their implementation, they say, like, let's table that. I'm going to give you the lead times. Assume that the lead time here is 5 days. Maybe that assumption is incorrect, right? When the contract was signed with the vendor, it was 5 days. Now it is in reality 10 days. So MEIO planned with 5 days, and reality is 10 days. So obviously you're going to have some issues. So typically what people do is that you look at the achieved service level and you try to then track back if the achieved service level are not up to what the target service levels are. Try to identify what the root causes are, and then take corrective actions. That's one way to do, right? The other way to interpret your question also is that, yeah, I think they were, let's say that in that particular example, they were used to, say, some 800,000 units of inventory, and that 800,000 units of inventory could have been calculated by APO or Excel sheet or tribal knowledge, whatever they did, right? So they were used to 800,000 units of inventory. MEIO comes in and says, I think you should be fine with 400,000, that you should be able to achieve 98% service level with 500,000 units of inventory. And indeed, it's a change management issue, right? So no one is going to say go all the way directly from 800,000 to 400,000 in a single shot, right? So what people do is they either try out the MEIO targets with a small portfolio or a small subset of your portfolio. They may try it out in one region, they may try it out in one product line and see what MEIO is saying. And when you execute to that, are you really achieving the service levels? And typically it does, right? And then the customer gets the confidence to say, okay, I'm going to roll it out to the entire portfolio. That's one way. Or alternatively, sometimes people also say that, okay, I'm used to 800,000 or say 10 days of inventory at this particular item location. MEIO says I should be fine with five days of inventory. Maybe I'm not comfortable going from 10 to 5 directly. So in that case, they might say, okay, I know maybe I'm carrying more inventory than I should. Rather than going from 10 to 5 directly, maybe I'm going to go from 10 to 9 or 10 to 8 and see how it behaves with 8. Right? I run it with 8. I didn't go all the way to 5 that MEIO says. I kind of settled in the middle point, at least at the beginning of the implementation. I settled in the middle point, right? And I run it with that, and they run with say that intermediate target for a couple of quarters and everything is looking good, right? Service level is fine. Then they say, okay, there's more confidence. Then they say, okay, yeah, I think I can go down lower, right? So they go lower. Or hey, if there's a problem, then you go back and take a look at the model to see are the assumptions you're making correct? Is the input data correct? If not, you fix that. So that would be the feedback loop.
Okay. I have a couple of more questions. I know we're a little bit over. Maybe I'll ask one more question and then maybe wrap it up. If some of the facilities in the supply chain network are operated and managed by a third party or outsourced, should the facilities be included in MEIO modeling analysis? It's like if these stocks are not counted in the company's stocks, the calculation of EOQ seems to be different.
I'm digesting that question, right? So if I understand the question, so you don't have any control over that particular facility.
Yeah, right? I think that's the idea,
yeah. And I'm trying to think, right? So it depends, right? A lot of times in my experience, even if people so it just depends on where the facility is, right? So if it is something, say, downstream here, like say at the vendor level, right? Obviously, you're not controlling the inventory that the vendor itself is carrying, right? But some of our customers, what they do is they get some raw data from the vendor, as an example, to say, just tell us how frequently you manufacture an item, tell us roughly what your lead time is. And the vendors, through vendor collaboration, they provide that kind of info. And they have MEIO generate a target, which is then published to the vendor as a recommendation that, hey, based on the forecast that we are seeing for the next 52 weeks, this is what I think you should be carrying in terms of inventory.
Yeah.
Obviously, if it is at this side of the supply chain, then again, you can do that. But if the question is that, say, if this facility is completely managed by someone third party, then in my experience, a lot of times, if you would have some control over this facility, right, even if a third party is managing, in that case, because this is in between this guy and these three locations, if that's the question, then typically unlikely situation. But even if that is the case, you would have some control over telling this third party on what kind of inventory you need to carry. In that case, you would generate the targets, and these targets would be published to the third party to say that, hey, you are sitting in between, and or even just for these two locations, and we think this is the inventory that you should be carrying.
Yeah, I mean, just to follow up on that, if I could just chime in, I do think that sometimes students often have this question, and you say you might think you don't have some control over. It's usually a supplying node, right? You might not have. You feel like you don't have a lot of control, but if you include them in your analysis, and you show that, hey, it would be a great idea if you could help us by holding more inventory, and we can realize this much inventory savings in our network. If you were to do that, then maybe we could come up with an agreement to share some of those benefits and collaborate, right? So sometimes it's useful to model that so you can see the benefit of sort of collaborative planning.
Absolutely. And I think just to follow up on that, as an example, that the slide where I showed that inventory saving, in that particular case, that customer, indeed, they were publishing inventory recommendation to their vendors for some packaging materials, so some critical packaging materials. They were publishing kind of a recommendation to their vendors to say that I think you should be carrying 50,000 units of this packaging material for January and 40,000 for February, so on and so forth. Right? Obviously, there wasn't a strict enforcement whether the vendor would really adhere to that, but it was being published. There was a handshake that was happening between this large conglomerate versus with their vendors for some critical items.
Great. Well, I mean, this has been a fantastic session, Asim. Thank you very much for sharing, obviously, the 09 package with us and answering all of the student questions about the process itself. It's been very informative. I've been very appreciative. I learned a few things today, so thank you. We actually probably have a lot more questions than we could than you can answer here today, but I think that's a good thing. So it shows the level of interest in the audience. So with that, I mean, I'd like to, again, thank you for your time. Thank all the students for participating and asking so many interesting questions.
Absolutely. It was my pleasure, and I appreciate you guys inviting us. thanks for that as well. Thank you very much.
Great, thanks, Asim. Thank you from us at the Supply Chain and Logistics Institute. Just to mention, Wednesday, April 28th, we'll have our final fourth session of our 09 hosted session. That's going to be on how artificial intelligence and machine learning is redefining business planning. So please join us Wednesday, April 28th. That's at noon Eastern time, and you can sign up via the SEL website. Thanks.
All right. Thank you, everybody.
All right. Thanks, everyone.